Hey, soldiers, the U.S. real estate market is collapsing. We're looking at a 40% collapse in a year. All right. And this is starting to have ramifications outside of just you trying to buy or sell a home. In fact, Wells Fargo just laid off mortgage bankers. It treated them to a retreat in California, and then it called them and told them that they don't have any jobs anymore. So it was kind of like a last supper. Listen, guys, go ahead and hit subscribe. If you are not a soldier of finance already, hit the subscribe button. That's all it takes. Make sure you also hit the notification bell so you will be notified every time we drop a report on this ever-evolving economy and how you can thrive in it. All right, so let's start with the Wells Fargo piece of it, and then we'll get into what's going on with this real estate market. It is collapsing. And you know what? I'm going to say something you might disagree at, the onset. This might not be a bad thing. Wells Fargo laid off hundreds of mortgage bankers this week as part of a sweeping round of cuts triggered by the bank's recent strategic shift. Now, of course, if the mortgages aren't coming in, because you gotta understand, okay, part of our business is real estate, and mortgage brokers do two things. Of course, they put together the financing for you if you are trying to buy a piece of property, of course. But a lesser known kind of role that they play is in refinances. All right. So you already own the property. You're trying to refinance. But the issue here is when you refinance, part of the goal is to get a lower interest rate. But right now, we're in a rising rate environment. So that business has pretty much dried up and blown away. So there's no refi business out there to speak of. So you got mortgage brokers just sitting around, twiddling their thumbs because the housing situation has gotten much more intense in terms of the decline in sales. And then you got a lack of refi business. Now, these layoffs were announced on the 21st of February, 2023, and ensnared some top producers, including a few bankers who surpassed $100 million in loan volumes last year and who recently attended an internal sales conference for high achievers. Now, look, that's instructive, guys, because like I always try to tell you, you're never safe in corporate America. People think, oh, I got a job, I'm safe. And that used to be the case, maybe back in the 50s through maybe the 70s, maybe. But ever since the 80s, having a job is not necessarily the most secure option to generate income, okay? And look, that's fine as long as you know that going in. It's not to say that a job is not worth having. If you calculate that, hey, I understand what's going on here. I'm trading my time for discounted dollars, and I'm not putting in heavy amounts of investment. I can go home at the end of the day. I don't have to worry about a balance sheet and all that stuff. And if things go south, I can just pick up and get a new job. I don't have to deal with the bankruptcy courts or angry share owners or angry customers or anything like that. Just go get a new job. So there are some advantages when there are pros and cons to everything. Under the CEO, Charlie Scharf, Wells Fargo is pulling back from parts of the U.S. mortgage market, an arena it once dominated. Instead of seeking to maximize its share of America's home loans, the bank is focusing mostly on serving existing customers and minority communities. The shift comes after sharply higher interest rates led to a collapse in loan volumes, forcing Wells Fargo, JP Morgan Chase, and other firms to cut thousands of mortgage positions in the past year. All right, I just want to, let's get into these, into exactly what's going on in the market as a whole. But first, let me tell you that they sent some of these mortgage brokers down here to this Palm Desert Resort swank place. Some of those people that were doing those loans were successful enough last year to be flown to a resort in Palm Desert, California for a company-sponsored conference earlier this month. Palm Desert is a luxury enclave known for its warmer weather, golf courses, and proximity to Palm Springs. Verizon used to do something like this with their sales folk. I never got the opportunity to do that because I wasn't on the sales side. I was on the lobbying and regulatory side. But they used to send them down to the breakers in Florida. And I've never been there, but I heard it was really nice. So looks like Wells Fargo had Palm Desert as their go-to spot. It's common practice in finance to reward top salespeople with multi-day events held in swanky resorts that combine recognition, recreation, and educational sessions. For example, JP Morgan's mortgage division is holding a sales conference in April. So they went down there. I'm sure it was nice. They acknowledged that they hit their numbers. Many of these people exceeded their numbers. And then, the music stopped and they didn't have a place for them anymore. Let that be in a little piece of instruction to you. When you think that maybe you're secure at that job, that might not be the case. All right, so when we take a look at the U.S. home sales, now we're talking about existing home sales. And what is meant by that is simply the house is already constructed. They got a whole different set of metrics for new home sales. Now, as you might imagine, we're in a bit of a doldrum since the interest rates are rising. It's causing the prices of a home, or what people will spend ultimately for their home, to increase. And we're in a weird little place here where sellers don't all have that message just yet. So they're going to have to moderate their asking price, if they can, lower it, in order to get that buyer out there to be attracted to that home, to that piece of property, and be able to absorb that higher interest rate. Okay, they can't very well ask the exact same amount of money they were asking, 18 months ago in an environment where money is more expensive. And look, let me say a couple of things about that. Number one, real estate is not a national market. So when the numbers that we're going to go over, they are national. But when we drill down, real estate is hyper local. So sometimes it's not even neighborhood by neighborhood. Sometimes it's even more discrete than that. Okay, focuses on a lot of different variables: the style of the home, the area, the proximity to a good school, crime. A whole bunch of factors play into valuations on real property. The other thing is, there's a general misunderstanding or lack of knowledge in America in terms of finance. So you still get people out there who believe their home is worth more simply because they lived in it. Okay. We had a home for sale in this area years ago that an NFL player lived in. Okay. He was from the Baltimore Ravens. And that guy priced that home ridiculously high. It was well above the comparable prices for the neighborhood. And his rationale was, hey, I lived here, okay, and I'm a football star. And he soon learned, well, it wasn't soon, actually. It took him a while to get the message that it's nice to see, people came in and they went through the house just to see where he lived, how he lived, but he didn't get any offers. He ended up holding on to that house for a couple of years, and then he reduced the price to the comparables in the neighborhood. So there's some adjustment that needs to be made here by sellers and by buyers. Because as you can see from this chart, we've gone through roughly a generation of mortgage rates that are below 7%. Okay. And so a generation of people believes that a 7% interest rate is just, something's wrong. They're being treated unfairly. This is not the American way because we've had relatively low mortgage rates for so long. Existing home sales had fallen for a record 11 straight months ahead of the most recent data print for January, which consensus expected to reveal a 2% month-over-month rebound. However, existing home sales for January actually tumbled 0.7% month over month. So it went down instead of up. Up was the expectation. And this is well below the 2% jump that was expected. And the record 12th, this is the record 12th straight monthly decline, with December's 1.5% decline actually revised further downward to a negative 2.2% decline. So people are saying, hey, I'm looking at these interest rates, I'm recalculating what I can afford, and it just ain't working. I cannot go out there and pay for this home at the price that they're asking and then pay for that money that, I'm going to need to finance this house. I can't pay that. The money's too expensive at the current interest rates. Now, Lawrence Yun, he's the National Association of Realtors chief economist. He said home sales are bottoming out. Now, what I believe he means by that, because Yoon is an eternal optimist, but I think he has a point here in saying that, look, these sellers are starting to get the message. Prices have got to come down. And when that is a ubiquitous message and everybody's singing from the same sheet of music, then we'll see an uptick in sales again. Inventory remains low. Inventory is just the amount of houses on the market for sale, but buyers are beginning to have better negotiating power. And they're starting to have that because, inventory is going to rise. And it is higher than it was, 18 months, 2 years ago. Properties remained on the market for 33 days on average at the start of the year. This is up from 19 days a year earlier. So you can see that demand has slowed. Homes sitting on the market for more than 60 days can be purchased for around 10% less than the original list price. That's helping to put downward pressure on home prices, according to Lawrence Yun, the economist over at the National Association of Realtors. The median selling price was up just 1.3% from a year earlier, the smallest annual gain in home prices since January of 2012. So throughout America, the median price for a home is $359,000. Now, of course, your neighborhood might be $500,000 or $50,000. Again, it's not a national market. It's going to fluctuate. But this is a result. Making that money more expensive is a result of what the Fed is doing, raising those overall interest rates, make that money more expensive, and it slows down the economy because people say, hey, I just can't afford it unless prices moderate, okay? And if prices have to come down in real estate, it makes sellers think, oh, I might not want to sell right now because I'm not going to make out like I would have. I'll just wait and sell when market conditions improve for sellers in a few years. All right, soldiers, check out this report we did on the insane inflation advice that the Wall Street Journal is giving out. We're being conditioned to accept a lower standard of living in this country because the economy is changing so rapidly. Most Americans are not going to understand why this is happening, but I want you to. So check out that report, and guys, I'll talk to you soon.